Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Tuesday, May 2nd, 2023. It is 1:45 p.m. Eastern Time as I'm starting the video, so we've got 2 hours and 15 minutes left to go in the trading day. I'm going to share my thoughts. I'm going to start out with the indexes and then just cover a couple things real quickly, talk about the regional banks. I'm seeing some quite a few falling off a cliff again today. I'll talk on that a little bit, how it affects or could affect the markets and what the Fed does. But let me start here because this is more timely. I like to get timely things out in the beginning of videos. I've gotten to get a lot of posts today. If you are an active trader, you know, there were a couple things that happened today. Number one, we had the first and foremost, as I highlighted it earlier today, we had that false breakout, failed breakout, bull trap scenario I talked about. You know, that really goes back to back here. So if we took out this trend line in advance, if we took that out, then that would most likely mean we're going to at least the top of the channel and then quite possibly break out above, and that any breakout above, in my opinion, would be a false breakout. Breakouts that occur with negative divergence have a much higher failure rate, and told you that was my preferred scenario, and that's what's now happened. And you can see it's, you know, the one thing I'll say about this too is that, you know, this is a, you know, significant level. I have the purple box and then really the larger box, which excludes these two spike lows. So going back now for the last week or so, what I've been saying is the next big and probably most significant sell signal is going to be a break below the bottom of that range, the yellow box here. The bottom of that's about 309.90 or so. Again, that's Tuesday of last week, the 25th, I think it is, April low. You had that one there. And so we're back into the trading range. And again, I've talked about this. The MO seems to be every time you hit the bottom of the range, or if you have a breakout that then is recovered back into the range as it was here, your next stop is the other side of the range, which was the top. So that happened there. There was a trade to be made, especially when we gapped above there. At first I told you I'd allow a little bit of a breakthrough there, but not above that trend line. So we gapped above it, shot straight to the top of the range, had a reaction there on the initial tag, pop low, and again we're back in it. So don't want to be the dead horse, but that's what the odds are now. Fed certainly has the ability to change the technicals or override, so take it with a grain of salt. In other words, not an all-in moment, but you know, if every Fed meeting, every earnings report, big earnings report, every economic report, you look at the economic calendar, there's something just about every day to give you a reason not to take a trade. So I've learned, you know, take first and foremost, respect the technicals, take it for what it is, and then look, if something changes after, fine. In other words, if the Fed, I'm going to talk a little bit about it here, or Apple, you know, the market likes what they hear, and we blast on through there, and then we start to take out the negative divergences, we take out these highs, things then start to change. And I'll let you know if it's going to be, for me at least, a near term or a more significant change. I told you before we even broke out, that was a good chance we'd do it, and there was a good chance it would fail. So now, you know, if we break out again, well, we'll see if it's going to be another whipsaw or so. You know, we still have a lot on the long-term charts that say we're going down big. And then again, there's things that say, you know, hey, we're above these trend lines, or these trend indicators are bullish now. So, you know, some indexes, quite a few above the 200 days. So again, I consider all day long. I'm not going to do that now. I've already done that quite a bit for months now, pointing out both bullish and bearish technical developments. And end of the day, you know, my job isn't to sit here and tell you the markets can go up, markets can go down. Duh, we all know that. It's to give you analyze the charts, show you the good, the bad, and the ugly, and you know, give you my take for whatever it's worth. So let's just see. All I can tell you is there's going to be some volatility between now and Friday, with the Fed tomorrow around this time today announcing the what's most likely a quarter-point rate hike, and then what happens after that. Of course, you'll have Apple. All right, so, you know, for active trader, you know, you fall back in the range was a sell signal. Would give you a nice short down to the bottom of the range. Once we fell back into the range, it was a drop of about, I got to zoom out to measure it. It's about 1% or so. And then the bounce so far has been, I don't know, better than 3/4 or so, and right about to where we should have gone. And that was, like I said in the post I got out to the button there. That was at midpoint of the range line. I gave you 317.60. Hit a low today of 317.61. Close enough for government work. And then the 5-minute chart, you have a little uptrend line, and then that the midpoint line, which we reversed off today. That's where the bounce came in. And then to really, sharpen my pencil, I typically trade NQs over QQQ, but I'll watch and always post QQQ during the day. I think that's probably if not a more important chart. But I mean, the levels are going to line roughly. You just see more levels. I'm talking about reactions, reaction highs, lows, support, resistance levels, because the NASDAQ 100 futures are trading around the clock. So what I gave you, and I hope that made sense, what I gave you here, let me turn off volume real quick, give you a little more space here. I gave you my plan, and it's a bounce target zone ranging from there, 13,175 up to this 230, what is that, 13,233 we'll call it. So, and you also have a downtrend line. So that's my most likely bounce target zone. You can see the little minor resistance we're at now, and so my plan was, cover those swing shorts, get that quick bounce trade, and then scale back in to as much as I feel comfortable going home with tomorrow, knowing that the Fed's coming. So it won't be a very heavy position, but I'll be back as short as I want to be going into the Fed tomorrow if we get up here. And there's one more level I'm watching. I'm going to zoom down for you and show you. If you go to a, let's do 1-minute chart of QQQ or NQ, the line drawn on a 2-minute, you have this uptrend line. So when this breaks, that'll probably send us back down today. So watch this uptrend line. You have a comparable one on ES, SPY, QQQ. You can do it on all those. And the way this works for me is I watch them all. There's a gazillion charts up on all my various monitors. You're only seeing a very small piece of what I'm watching at any given point in time. Let me find that ES chart. 1 second. Here it is. All right, so there's the uptrend line on ES. So what I'm on are 1-minute charts. And so this is kind of timing, the entry. So this is probably a little buying climax going on here. We're going to get close to my max bounce target in a second, and I think we'll get a reversal. And there's also a pattern. It comes into play anytime from about right now up to about 2:30 p.m. is usually when the pivot comes in the markets. So we have maybe another 45 minutes. Let me get back to the NQ chart. I'm going to just because I'm doing this in real time, I may have to pause the video and make a trade here. We had, where was I before? I was on this 5-minute chart. Yeah, getting really close, and yeah, close for me to fire off another lot of NQ shorts. We're getting very close to that level there. And again, when the trend line breaks, that'll be, at least for day trade, swing down. You could always, we have up till 2 p.m. tomorrow before the Fed announcement. All right, so that's just kind of micro stuff. And again, if that's not your wheelhouse, you're new to trading, investing, you're only, you're not interested in gaming 1% moves. You use enough of anything. That's the thing about it. Broker will give you plenty of leverage, even if you're trading just QQQ. If you're trading futures, obviously they're inherently leveraged up pretty good, and you can put quite a bit in your pocket. So this is more day trading stuff that I'm talking about here. But let me get back to the bigger picture, guys, for those of you that aren't into that. And so here's a 5-minute chart of QQQ, same one I've been showing you, and you can look and just see. I'm going to put crosshairs. I don't know if you can see my day break lines. Yeah, I can turn them up for you. No, I don't want to pause the video. Look at the volume bars. I can just show you. Here's a day break line right here. There's another day break line. So that's the spacing on them, right? I have them tuned down. I don't like very busy charts with a million things. I can just make them out. And you can see the pivots come, quite a few are around anywhere from about, like I said, about where we're at now. That's, if you look at the pop-up box, that's 1:45 p.m. That's where the turn came in the market. A lot of them you look at, it's around up to about 2:30. So like I said, we're in that window here, right here. I put the crosshairs, 2:25 1:45 p.m. You had that market stopped going up, and that was a peak for the day. Right here, that day it was 2:20 p.m. and then a hard down. Last minute. No, that surge was actually the following morning, so you sold down. So you get the point. We're there. Maybe one more lot I'll add to this today, either on a push up into that final max bounce target I gave you on the 5-minute chart, or a break of the 1-minute trend lines on what I just showed you, SPY. I showed you ES and NQ. You can see them on SPY and QQQ as well. There's QQQ. Go to 1-minute chart. There's your trend line. Looks like this right now, and you want to see them all break. What happens? One will spike through there and the rest don't. There's SPY, and you can see that you get a little surge like that. That's typically a near term, when you go parabolic, near term buying climax. That's why I paused the video there and added second to last lot of shorts that I've scaled back into today. So far so good. Now let's talk bigger picture. Let's talk the interest rates and the Fed and banks. So let me start with the banks. And of course, we all know what's going on in the regionals. And if you know this about regional banks, everyone, the mega banks are ginormous, and they dwarf in market cap and the amount of assets. Especially J.P. Morgan just keeps getting bigger and bigger. This is almost a joke. Back in the financial crisis, they came out and in hindsight admitted that the Fed and the banking system have allowed a lot of banks become too big to fail, and therefore they had to be bailed out, and taxpayer dollars back then, because again they were too big to fail. And what did they happen? Well, those banks have only got bigger, and you saw J.P. Morgan yesterday taking, was it First Republic? Over the government engineering that one. So of course, J.P. Morgan was already the biggest bank to begin with, and now they're even bigger. So whatever, go figure. But here's what I want to show you. I know I'm rambling here. Keep an eye on this stuff. These are red flags. But what I was going to say before is regional banks, although not any one of them is near as big as a J.P. Morgan or Bank of America, there are a whole lot more of them, and they account for the bulk of the lending for commercial projects, small businesses, and all that. The big banks, they're focused on those big mega deals and bringing companies capital, and bringing companies public and things like that. So what I'm seeing here, and I'm just clicking through and I'm looking at, I'm going to sort this out and look at the ones that are down today. So here's what's going on. Here's PacWest Bank down another 25% today as I type or record this video. 16, almost 17% down on this one. MCB. These are all in KRE. These are regional banks. WAL down 16%. So I laughed a few weeks back when they first bailed out, or not bailed out, I'm sorry, when Silicon Valley, which was up until 2 days ago the second largest bank failure in the history of the United States. That comes by in Washington Mutual, and then of course we had First Republic. So it's one after another, and I said you wouldn't see the end of it. This is not this is a ongoing thing. And this is HMST Home Street down 14%. So you can see, and here's what I'm having a hard time putting my head around, that the smartest of smart money, those who trade the or so-called smart money that trade the Fed fund futures, are still, I just refreshed the page, pricing in at this moment with a continued meltdown, and there's going to be more failures, is what I'm trying to say, in the regional banks. And more importantly, I believe it's going to spread throughout the financial system. I do not believe anything it's contained. The financial markets are very interrelated. So you have the shadow lenders, you have the big banks, you have insurance companies, etc. A lot of potential cracks here. So they're still pricing in. The Fed's going to give the quarter point, and we all know that if they do that, which again, the market would be shocked if they don't. I talked about it before. There is a potential for an explosive rally. If the Fed comes out, remember, the Fed goes into a blackout period leading up to an FOMC meeting, so we haven't heard anything from them. So this is just the market speculating. If by chance, because again, I'm concerned, I'll trade the market, whatever comes my way. Don't get me wrong when I say I'm concerned. If it tells me to be short, I'll short. But as far as these regional banks, yeah, for the overall, global financial system, the U.S. banking system, yeah, I'm very concerned that you see a lot they're continuing to, after a little period of consolidation and a pause and like a relief rally that we got after Signature Bank and Silicon Valley Bank, now you're seeing just a resumption. And that's just a bad sign, anyways. So where I'm going is, I think the right thing for the Fed to do would be to not raise rates at all because they're breaking the system. I've talked about it, time and time again here that we're coming off. It's not so much at a 5% Fed funds rate is high. It's historically low, or more in line with anything we've seen in recent decades. But it's the fact you go from 0 to 5%, and that's the biggest increase. And you're also doing it after a nearly 2-decade period of near zero rates. And where, again, I've used the analogy of a heroin addict that's been doing heroin for 20 years. You can't take them off cold turkey. And so that's what's happened. And, I and others said they're going to break the financial system. And it's funny, again, I'm in Bizarro where you're seeing it. Everything is breaking, but they're ignoring it, and even worse, the flight to safety instruments de jour are tech stocks. And I get it that tech stocks and Apple, for the most part, has nothing to do with regional banking, the regional banks, but they are and always have been, and please hear my words, always will be sensitive to the economic cycle. We are heading into recession. So many things point that way. And if the financial system breaks, there's no net positive with, I think some traders initially got excited when we had problems in the banking center. It was topsy-turvy and everything went backwards, and they rallied on the fact that problems in the financial system and the banks would cause the Fed to pivot and then start lowering rates. But no. The net effect is it's going to unarguably constrict lending standards and access to credit. So there's really, the only net positive you can try to take away from problems in the banking system is, again, the fact that the Fed may pause or pivot on their rate hiking campaign. I think it's baked in the cake now. Fed funds futures are already projecting that too, that they turn around and start cutting. So I'm probably spending more time talking about tomorrow, but let's see what happens. Just caution, I think, is warranted. Again, the Fed hasn't surprised in a long time, but if they happen to come out and not raise rates, I think my best guess would be an initial explosion to the upside in the market, which is one to be sold into. Take advantage of that and short into, because I think it would be very short-lived. And after that, everyone would be talking about, what does the Fed see? The Fed has access, they're privy to see things we're not in the financial system. So what are they worried about to pull a 180 like that? So I don't know. At the end of the day, I have to go off with the Fed fund futures being an 85% chance that that's probably what we're going to get, and almost a near certainty that they're going to say that's it for now. We're going to watch, we'll monitor, we're going to fight inflation if we see it, blah, blah, blah. But I've also seen, by the way, guys, remember, I'm kind of all over the place here in this video, you can call the inflation numbers ahead of time. This is it. So this is my real-time inflation indicator, DJP. It's one of the most diversified commodity ETNs. You have energy in there, natural gas, gold, crude oil, Brent crude, soybeans, copper, corn, all of it, you name it, gold, silver. And here we are. What was it? I've done these little boxes for you. There they are. And show you when we're having periods of, you can just get ahead. This will tell you what the CPI is going to come in with a pretty good, margin error. Here's April. There's April. We started going up, but then we ended the month pretty much down. Whereas the box would be right here. There's April 20. Okay, so right there. So you can see overall by this one metric, and I know it is not all inclusive. I always say that it doesn't include services, it doesn't include real estate, but it does include the big, some of the big things, which again are food and energy and all that. And that tells me there's been a marked or notable abatement in inflationary forces last month, which will be reported on the next CPI. Again, gives the Fed all the more reason, and we're still zigzagging down. We haven't yet taken out that previous low in DJP. I still believe we're in an early stage commodity bull. It's just a correction that's not yet run its, or maybe has. Technically that was the bottom there. Yeah, but you can go back to the weekly chart and see that this was the bear market in commodities. This is just early stage bull market action. That's where I mentioned it was a great buy last time, I believe, around 30.80 or so. Fib retracements and all that. And we're still there. So I think, ultimately we go back up. But that's just my guess longer term. What I can tell you definitively near term is inflation's down. The banking system is literally crumbling in front of us, especially the regional banks. And so that's it. So one way or another, let me just summarize this. You're going to have some dovish, what will be perceived as dovish pivot type comments out of the Fed. In the most likely scenarios, they're going to do the quarter point, but make it clear that they're, standing by for the banking to have other tools to, keep the financial system lubricated and well running, blah, 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 blah. But they're pretty much probably going to signal a near-term pause in rates. And if they happen to, like I said, cut, initial knee-jerk reaction will probably be positive, but at the ultimately it would be a negative, I think, on the stock market, with investors becoming very nervous. Why did the Fed all of a sudden change tunes so fast? So that's that. Okay, so you saw it. You can see the regional banks are melting down. Follow those. Not getting any better, getting worse. Again, KRE, if you just want to look at one single thing, that's the ETF for the Regional Banking Center, making a new multi-year 52-week low, and quite a bit too. Had this period of consolidation, really downward to sideways consolidation, zigzag, and now right before the FOMC meeting. So the Fed, boy, they have their work cut out for them. All right. I don't want to make it a super long video. Let's just keep it limited to the stock market. Somebody asked me about oil. Both CL and USO are at pretty decent support. If you look at my USO chart, the crude ETN, this one does a really good job of tracking that line right there at 62.90. Lots of reactions on it. It's support. And my reply was, I don't have a horse in this race right now. I don't have a position in crude. I suspect it'll bounce here. A lot of things say this is support and will probably bounce. But again, I'm not betting it, not in front of the Fed. One reason why, I can make a case, go along at support. Crude is at or just a hair below crude futures, that is. You can see my support line here, about 72.50-ish right there. There's a few spikes below, so it's more of a zone, and we're there. And, potential divergence. But if I'm correct on what's going to happen in the stock market in the coming weeks to months, that will be a possible meltdown. I'm calling for a 20 to 30% drop still in the Nasdaq 100. And I know the comments. I most have given up on shorting, and I've been saying just buy the dip, don't fight it, blah blah blah. But I think we look at different charts. I look at the Nasdaq 100. Here's today's low, where we were just a few minutes ago when we covered those shorts, day trade shorts. And this is where we were. Let me start here. This is where we were back in the beginning of February 2nd. That was 3 months ago. The Nasdaq 100 is up a whopping 1.25%. So I made a case back then, give you my most likely bounce target zone. We hit the top of it then, we hit the top of it here. We had divergence. I've been, bearish looking for that leg down since then. I always use the difference, my terms, difference between being early and wrong is being wrong is if you short something and it goes up and then you're stopped out for a loss. It exceeds your stop or where you thought it might get. That's wrong. Early is you get in, you start shorting this for a swing trend trade, and it's it. You're right back to really, we've gone pretty much nowhere. As I said, in the last 3 months, we're up a whopping 1.25%, and on the S&P 500, which is more of the stock market, in that same period, over 3 months here, from the spike high in February 2nd to today's lows, down 2.5%. So the stock market itself has gone nowhere. Tech has gone slightly higher. Time will tell if it's going to continue up, but to me, it's just a battle of bulls and bears, and you've got your trading ranges, and that's it. Let's just see where these are resolved. Like I said, the macro, I will give the market points where point and credits due, and that is holding up in the resiliency of a banking crisis, which I guess you can call it that. Collapse of all started out with in the crypto arena, and as I predicted at the time, I said Wall Street had their hand elbow deep in the cookie jar with crypto. First, they were all denying it and thought it saw it as a threat, and then they all jumped on board, especially the big banks, and they all started dealing crypto, and some even taking crypto deposits on some of the bigger banks, and all this stuff that since transpired. But anyway, that's it. So we've gone nowhere. I'm just trying to say, take a look at that. Bulls haven't won, bears haven't won. You've had a down off that initial divergent high there, and you've made roughly equal highs in SPY, making the divergence even larger. And remember, back here in SPY, we did not have RSI divergence, which we did at the most recent high just yesterday, actually. You can see that that's the divergence right there. And the NASDAQ 100 as well with that marginal new high, which was just that. It only extended the large negative divergence in place, and that's that. All right, time will prove me right or wrong, and I think that time is coming. Like I said, this trading range, particularly QQQ, very long in the tooth, very long, very tightly compressed. We fell back in it today. If you just want to be a purist with the charts, know this, that a failed breakout is bearish, and also a rally to a top of a trading range or a false breakout with a move back in, again, significantly increases the odds that the next stop, other than that bounce we anticipated today, will be the bottom of the range. And because this range is so long in the tooth, sooner or later it's going to break. We had one little false whipsaw to the bottom, and that was all due to earnings. Post earnings, you're going to get those whipsaws. One to the downside, and that's post Fed and now post Apple earnings. So like I said last week, I really think we're going to know by Friday or next week at latest which way this range is going to break, and I'm talking the final direction. And I think it's going to be we're in other words, the direction that's going to determine the next 10% or more, the next double-digit trend, i.e. swing or trend in the market. And nothing has changed. Not a single thing I've seen over the last few weeks has altered the long-term, my read on the charts from a longer term perspective, and even a near term perspective. So that has the potential to change soon, and if I'll do my best to convey my thoughts if and as I start to say, you know what, market sometimes it just looks like the world's coming to an end, you're got a banking crisis, and that's the time you want to buy sometimes, when there's blood in the streets. So I wouldn't say there's blood in the streets now, and that's one thing this bear market so far has been lacking, is any type of capitulation type bottom. So we didn't see that. Yes, the market's been going up since October, but all bear market rallies are an uptrend. All bear market rallies will do that, and this one is no different from any other bear market rally as far as Fibonacci retracements or anything like that. It's a little bit different, a little bit longer, but from day one, before this bear market started, and almost every day since, I maintain that this bear market, in my opinion, will be a lot different from anyone in recent history, and that's why I don't see a lot of folks talking about this, that I'm, based on my macro fundamental and technical analysis, I think this is going to be a multi-year bear, not an 18-month bear like the last two real bear markets from 2000 to 2002 and 2007 to 2009, which was October of 07 to March of 09. So those were about a year and a half, and they were big, 50+% drops. But I think we're going to be looking at something much more longer, because I'm looking at a secular change in interest rates and equities as well. All right, guys, let me wrap it up here. And again, you'll go broke trying to aggressively position for long-term trends. You got to use the shorter-term charts to kind of know when to start covering shorts in a downtrend. Even if you're trying to swing this whole bear down, you will not want to ride out the bear market rallies. And correct me if I'm wrong, but we've been covering or going long on or around each bottom. Again, admittedly got in a bit early on time this time around for this swing or trend short, and but certainly not too early in price. So if there's anyone out there that can't tolerate a 2, 3, 4, even 5, or even 10% stop, if they're looking for 20, 30% downside, then I don't think this type of trading is right for you. So I've always said, I'm going to leave it here. I make a lot of little sayings up, my own little yogiisms, and one of them is, in life, if patience is a virtue, in trading, it is an absolute must. So if you're a day trader, you shouldn't be in a trade that you started 2 months ago. If you're a trend trader looking for a double-digit 20, 30% move in the market, yes, sometimes you're going to nail it with technical analysis, and sometimes you might get in a little bit early, or you might get in at the right level, and it just takes a while to play out. So those are my thoughts, and I will let you know after the Fed does what they do tomorrow and what Apple says, and more importantly, what the market thinks about Apple on Thursday night. So we're really not going to know until Friday morning. I've warned you repeatedly, do not read too much into an initial earnings, what a stock does immediately following the earnings report. Amazon, if nothing else, lately taught us that. It ripped post earnings immediately following the report after the market closed, only to see 100% plus of that rally reversed, starting with their conference call when they said, I think it was cloud growth, cloud was slowing down or something else. So just let the dust settle is my advice, especially for trend traders. It's the old two bulls story, and just take it easy, and you can always add to, scale into, continue to build short positions if that's what you've been doing. And like I said, there's that big reaction low from Tuesday before last. Should be, in my opinion, the nail in the coffin if and when that's taken out. And if it's not next week, I'll let you know my thoughts. You know me. All right, guys, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.